This is the Multifamily Takeoff podcast, show number 130.
And now, out of San Diego, California, streaming to listeners around the world, this is the Multifamily Takeoff podcast, where we'll talk all aspects of anything multifamily real estate investing related, as we host a variety of guests who are active in the apartment game. Be sure to follow the show on Instagram at the Multifamily Takeoff. Now, here are your hosts, Mike Ty, Sean DeMartel, and Rich Summers.
Welcome in, listeners. Thanks for watching the show and listening to the show again. I'm your host today, Sean DeMartel. Don't got Mike or Rich on the show with me today because they're actually touring a boutique hotel we got under contract in Northern California. You'll probably hear us yapping more about it because it's right on the coast with beach access, things like that. And so far, everything's looking pretty good with that. But I am excited about today's guest, Hoa Nguyen. She was a great guest. I think is going to provide a ton of value that you guys are going to really like. In particular, if you're new to the industry or trying to co-GP or sponsor your first syndicated multifamily deal, I think this is a great episode for you. We talk a lot about not only how she grew so quickly to over 5,000 units now in just a matter of about 5 years, but more specifically, we talk about a lot about her journey and going through a mentorship program, finding other partners that complemented her skill sets that she then started co-sponsoring deals with. She's co-sponsored on numerous deals in her portfolio. They have over 20 deals now that they've done. So I think that, listening to this episode, this is going to give you a lot of insight on some of the barriers to entry in trying to get into the multifamily space if you're not even aware of them, and why partnering with people that have experience or have a missing piece that you don't have can be so valuable in your journey. So without further ado, let's go ahead and get to the show and let Hoa tell you herself, but not without a quick word from our show sponsor. And please don't forget to like, subscribe, all of that stuff to our podcast, because it helps us get seen by more listeners, more viewers on YouTube, all of that stuff. So without further ado, let's get to the show. All right, checking in with our guest today. It's Hoa Nguyen. Welcome to the show. How you doing?
I'm great. Thank you for having me, Sean.
Yeah, thank you so much for coming on the show. Like we always start, let's just start from the very top here and tell our listeners who don't know anything about you a little bit about, what you do in real estate, and then we'll kind of talk about how you got there.
Yeah, so currently my husband and I, we're full-time. We're partners, also life partners and business partners in the real estate syndication space. We started about almost 5 years ago in multifamily. Prior to that, our real estate journey was more buying land and single family Airbnb.
Gotcha.
And now we predominantly just focus on multifamily syndications.
Okay. So can you tell us what your portfolio looks like? Like how many units or assets under management?
So we currently have 21 different properties, over 5,300 units.
Wow.
Yeah, and let me see, 360 million currently assets under management.
Mm-hmm.
Most of those are within Texas. DFW and Houston is the bulk of our portfolio. And then we have one property out in South Carolina.
Okay. So tell me, I'm curious how those initial investments in real estate went, because you kind of dabbled in land, single family, and even Airbnb before going all in on the multifamily. How did those investments play out for you? In particular, even the land, did that end up panning out to be a good investment?
So funny enough, our real estate journey actually started in another country instead of here.
Oh, yeah.
So I traveled to Belize a lot. 7 years ago, I started going to an island there, Ambergris Key, little town called San Pedro. And it started off as a vacation where I kept going back and fell in love with the island. And so I started buying land there and did a couple of real estate field trips to learn the market. And that was pretty much all our money, where we didn't syndicate it. We didn't finance it because the interest rates were so high, and financing over there was going to be a challenge.
Mm-hmm.
So we parked a lot of cash just buying land. And then with one of the lots of land, it was built right next to a resort. And we actually did do a part syndication into that resort. It was the first branded resort. And so we figured, hey, there's a street right next door. It's still within the resort. We can buy the land. We can build a custom home that'll be a vacation home for us, but also we can Airbnb it when we're not there.
Nice.
So the land was a long-term play. We knew it wasn't anything for cash flow purposes, no tax advantages or anything like that. But property taxes were very cheap there. I mean, we literally paid $200 a whole year for our land and properties over there. So it's dirt cheap as far as that. And, so we figured it was a passion project where we were going back and forth. We were going to stay in it. The land was going to be a long-term hold. We bought we bought 3 different parcels, 2 of them beachfront, with the plan of developing once it becomes more popular in that area.
Yeah.
So those were long-term plays, but that's before we knew before we even knew multifamily and the syndication model on multifamily, because we parked a lot of cash that just kind of sat there and didn't return capital for us.
Gotcha. So let's start talking about the multifamily part then. What was it that triggered you guys to transition and start in the syndication multifamily business?
So once we started learning, it was just a matter of lots of meetups and bigger pockets and just understanding different avenues of real estate, because we were just trying to figure out what's our sweet spot where we weren't parking so much of our own money and we weren't doing as much work, because the whole reason we went into real estate was to buy back our time.
Right.
I mean, we're both eye doctors. We have 2 private practices. And so when my daughter was born, that was the whole reason we pivoted into real estate. And so when we learned and we went to different programs where they were teaching multifamily syndications. And so we joined a mentoring program. And that's when we learned hey, we could really partner with other people who have way more experience and then divvy up the roles and, raise equity and put money together and buy these larger projects and scale so much easier. And it had all these advantages that all my other assets didn't have.
Mm-hmm.
But man, I've been playing in the wrong space.
Right.
And so that kind of helped us transition over and really scale our portfolio pretty rapidly. Once we started doing that, once we knew kind of what part of the equation we enjoy doing in the multifamily and what we were really good at.
And what part is it that you enjoy doing?
So there's 2 pillars of the multifamily we really enjoy. Capital raising, investor relations. That's the big bulk of what we do. And then also the acquisitions. We love going out there, underwriting, finding the deals, getting to know the brokers. So sourcing the deals and sourcing the capital is really our 2 strengths.
I like that. So where are you guys at right now in that whole time freedom journey? You said you still had your 2 private practices. Now, are you guys still in there working there yourselves full time?
No. So, I go in there by choice now 2 days a month. So I've been practicing for 16 years. I only see patients by request who still specifically want to see me, but we've hired 4 other associate doctors now. So we literally don't even have to go into our practice anymore. It's streamlined and we've built systems now. And we've had 1 practice for 11 years and 1 for 9 years. But literally we come and go as we please and practice as much or as little as we want. But 2 days a month, if that is what I go in now.
That's awesome. And it's still an income stream for you on top of all of the real estate. So, I mean, that's a beautiful thing. Speaking of eye doctors, though, I got LASIK done 2 years ago. I'm so happy I got that done.
I know, right?
I wish I would have done it a long time ago, because now I have 2015. It's just 4K HD everywhere. I love it. So tell me, I'm really curious. So you mentioned that you guys leveraged partnerships. You alluded to the mentorship program, which I'm sure opened a lot of doors as far as partnerships and whatnot. So how, in this whole process with you guys, the primary hat you like to wear is capital raising. Where did you source a lot of these investors? How did you convince people to, get in on these investment opportunities, all that kind of stuff?
So it's a lot of education. It helps that I'm also a doctor, of course. So a lot of my sphere of just personal friends, starting there, I'm optometrist, But then a lot of my friends are dentists, chiropractors, medical doctors. So all different types of doctors, healthy professionals who don't want to get into the real estate space by themselves. They don't want to invest the time or money to go learn it and do it themselves.
Right.
They want somebody to help that they know and like and trust that can put their money to work for them. And so just getting out there and just educating people on what we were doing, I started there, right? Just immediate circle of people I knew. And then the biggest change for us was when we started going to different groups like entrepreneurs and doing a lot of speaking engagements and just educating people about the multifamily syndication space and kind of teaching that a bit. And so people would just naturally gravitate and want to learn more. And then it went from one to many, and then we just filter it down to one, and then just build those core relationships and a lot of referrals to us. And so we grew very rapidly in our investor database. And so that's how we were able to raise, project back to back to back.
Wow. So, yeah, I mean, that's just an incredible, level of scaling too, to go to, you said, I think around 5,300 units and just around 5 years. What would you recommend to people that are listening to this podcast that are debating whether or not they want to join a mentorship program or something similar? And most of these things cost, 5 figures. So what would be your recommendation to somebody that's debating that? And maybe even tell us a little bit about your experience going through a program like that.
Yeah, I think number one, when you join the mentorship program or any type of program, having a clear understanding like what role you want to play. If you want to be active or you generally just want to be passive. I mean, if you're just a passive, I think as a limited partner, I don't think you need to spend 5 figures to go into a mentorship program. If you're going to be a limited partner, there's a lot of good resources and people you can learn from to be a limited partner. But as far as like to be a general partner, if you really want to actively get into the multifamily space, and there's so many different programs out there, but I think the success of the students and the people who are in it is what makes it, not so much the teachings, because you can learn the content a lot of places where you don't have to pay, that type of money.
Right.
But I think what's more important is really leveraging like the people who are in the group for potential partnership opportunities. And so, if you want to go in and do asset management, if you're strong on operations and project management, if you want to do capital raising, if you want to do sourcing the deals and you're good with contracts and lending, and so it kind of depends on you. You got to have a clear understanding of what you want to do before you're going to go in and spend these 5-figure mentorship programs. Because I've seen people go in, spend all that money and wind up just sitting on the sidelines, really not doing much with it.
Oh yeah, I see it a lot too.
And so, for us, it was like, man, if we're going to invest this kind of money and time, like we're all in, right? But we got to make it really clear what we're looking for. So we're not going in and just like spending a bunch of time just chit chatting, kind of figuring out like, hey, what are our strengths? What do we actually, and you'll learn that as you go and learn the ropes. You got to learn the foundations and then start talking to people and figure out the missing piece of the puzzle for you of who's going to complement your skill sets and to make a team. And so most people, if you're starting off, most people need equity. So if you know nothing in multifamily and you can raise capital, and you've got a good network, and you're like, hey, I'm a doctor, or I'm not even a doctor, but I know a lot of people who have money who want to invest, then start with that. Like if you can partner and get under the wings of an experienced operator in a team that has good deal flow and they've already been successful, there's always a need for capital.
Yep.
If you can go in and your strength is like, hey, I know I can bring in X, Y, and Z, and you'll learn the ropes with them, that's the best and easiest way to get your foot in the door. And the mentorship programs, if you find the right people in the ecosystem, like for me, that was the biggest win, was a lot of my partnership opportunities were because of the ecosystem through the mentorship program.
And how long ago were you a part of that mentorship program?
4.5 years ago.
Okay. So right after that is when you guys started to see the rapid increase in acquisitions and really growing your portfolio, huh?
Yeah. The partnership opportunities and a lot of the learning, and I do a lot of masterminds. smaller, intimate groups where you really focus on, and just hang around people who are doing things. They always say, like, hang around people who are already successfully doing what you want to do. And so if you can get in a mastermind, like that was the next level up from the personal mentoring, was like, hey, if I can mastermind with the people who are hitting these big numbers and doing what I want to do and just pick their brain or partner with them, man, that's the way to scale. And that's what we did.
Oh, yeah.
That's what we did. We just masterminded with people who were already in that space doing what we wanted to do, and leverage their resources, leverage their skills. And we just focused and honed in on what we were really good at and figure out what did they need. How can we add value to them?
And out of all of these units that you're a GP on, are most of these with the same group that you co-GP'd, or have you done various partnerships?
Some of them are the same and some of them are various. So it's not all of them the same.
Mm-hmm.
So right now we have nine general partnerships, and we're working on our 10th one right now, actually. And 3 of them are the exact same. It was just another partner. It was another husband and wife team. And all the other ones are slightly different people, but they're all part of all of our projects have been people we knew through the ecosystem that we've known for a few years.
That's amazing. So tell us a little bit about your experience right now in the market, because that's been a hot topic. Interest rates rising, the competition has been fierce nonstop over the past couple of years. Have you guys done many acquisitions this year or even, recently, despite the environment?
Yeah, this past year, we've done 5 acquisitions. Mm-hmm. We're working on one right now that we were supposed to close. But lender, because of the the markets right now, it's a little crazy, and so lending's a little trickier, interest rates, but we've already accounted for that, so it's no higher than what we already accounted for. And then terms, we were supposed to close because of the volatility of the market right now. Lenders are being a little flaky,
Yeah. Yeah, trust me, I know. Yeah, I think because of that, but I think all of us in this business are keenly aware of the supply and demand issues. And, even despite the interest rates where they're at, there's a lot of confidence, and a lot of people are bullish on continuing to acquire these assets. What are the goals for you guys over the next, let's just say, between 2 and 5 years? Is it just to continue acquiring these multifamily assets as much as you can, or do you have like a specific goal in mind?
2 to 5 years, we'll probably continue scaling the way we're doing. We're predominantly in A and B space. We haven't done new development yet. That's probably going to be the next phase for us, is to consider doing new development and also look into build BTR, build to rent communities in the hot markets. And, we have someone who we've known for many years. He's a developer, and that's what he's worked on. And so that's kind of probably be within the next few years. That's something we want to look at.
And why do you want to make that transition?
We're going to still stick with multifamily,
mm-hmm.
but to also have that opportunity if the cost is right and they can buy the land right, and if we're able to, for cost bases and things, it's also a rent model, and we can refi out and have like infinite returns in a model where we're going to hold longer instead of doing a 3 to 5 year hold traditionally like we do with multifamily. It's just diversifying our portfolio.
Yeah, I like that. Okay. But traditionally you guys have been doing have they been value add A's and B's? Because you said you're primarily A's and B's, correct? So you've been following the value.
Light value add. So very light value add opportunities. We don't do any heavy value add. Prime markets are predominantly what we're looking at, 250 and up, A and B prime markets. But they have to still have a value add component where we're buying at lower cost per door. Rents are still lower than market comparables, and but all the rent, obviously, because the market's been so hot, has been outperforming.
Mm-hmm. I'd like to talk a little bit more too about your partnerships, because I think that's one of the unique things that that you bring. And a lot of people out there listening to the show are people they're maybe newbies, or they're just getting into the space. Partnering is obviously something that's basically a necessity for them if they want to start these big syndications. So when it comes to that, how did you approach even bringing up a potential co-GP partnership with some of the groups that you have partnered with?
Yeah, I mean, it's I don't even honestly have that front conversation until I kind of get to know them. And so I passively invested that first whole year. I didn't even attempt to co-GP.
Oh, okay.
I did 8 limited partner. Um, so passively invested strategically with people that I wanted to co-GP with, because
Okay.
I wanted to see how they did business, how they communicated, how their systems were. And so I was a very active passive investor. And so I started building my database even as a passive investor, attended a bunch of meetups, conferences. I was at all the different events and
Mm.
all the big names I would attend. But even as a passive investor, I was very in depth in keeping in touch with the co-GP. And so that they got to know me, and so the hope was that I would potentially be able to partner with them. And every single person that I have was a passive investor with, that was on my list of people I wish I could co-GP with, I have co-GP'd with.
Wow.
So it's just manifestation. It was just like, okay, these
Yeah.
are the people I want. I really like them. They're good people. They have a good track record. I would love to do business with them. Let me passively invest with them so I can get to know them. And then once, about a year or so passed by, then I would open the conversation, you know,
Okay.
but that's how I would love to, partner. This is what I can do. Da, da, da. So it's just opening that conversation and being clear. But then at that point, they already knew me.
Yeah. And that's a great strategy. I mean, like you're not going to partner with somebody right away until you really understand how they do business. And it probably isn't a good idea to do that until you've done, you've really gotten to know them and see how they work. Another question that I'm sure everyone's thinking that's listening to this is, what does a typical co-GP setup look like as far as split? Like, there's got to be people listening to this thinking like, okay, I think I could raise capital too. I don't have time to do all the asset management. I don't have that experience. What kind of like splits could somebody expect? Like, I know it varies, but can you give us some ballpark numbers?
Yeah, it like you said, it really varies on the project and how big and what roles you're going to play. And if you're coming in and you're strictly raising capital, and obviously you can't get compensated just for raising capital, so you're going to put in some sweat equity. But I would say if you're able to raise capital and you have some net worth and liquidity, where you can leverage that to be on the loan, a
Hmm.
guarantor, and that will be a resume builder for you also. If you have some liquidity where you can help with some of the earnest money or hard money up front, some of those costs, anything that you can help with addition to that. If you can do some of if you're tech savvy and can help with some of the investor portal stuff, the webinar presentation deck, anything that you can add in addition, of course. But the biggest portion being, of course, raising capital. Some teams it ranges. I mean, some teams might allocate between 30 to 50% for equity for just the capital. And then they kind of divvy it up depending on how much capital you think you can bring in, you know? And so it can be very low if you're only bringing in a million or 500,000 versus if you're going to bring in, say, $3 to $5 million, and depends on what the total raise is. But most teams will kind of carve out 30. I've had it anywhere between 30 to 60% where that portion is for equity, if you're mainly just doing that portion. And then depending on how big of the raise and how much you bring in, then that's kind of estimated about what you should expect. So that's kind of been standard. However, for us, we always wind up doing more than just raising capital. Most teams will need us for net worth and liquidity and the hard money up front. And we do carry a lot of multifamily resume experience, so our track record in helping overlook some of the lending or contracts and things. So kind of a strategic partner too. So we're able to leverage a little bit more, but at the beginning, we're willing to take less just to get our foot in the door. And then after that, you can start negotiating your portion. And once you know your value and your confidence starts to build up, and you know that you can bring in X, Y, and Z of capital or whatnot, and you can play more roles to help the team, then you can negotiate and kind of on the upfront end, maybe ask for more, you know. But like you said, it varies a lot on what the team needs, and you know. But if you're coming in and you're expecting a lot, like if you find a deal and you're going to help raise capital, you're in a different position. If they've already have the deal and they don't really need you, and you know you're a small piece of the pie, you can't really demand and negotiate a lot.
Right. You don't have any leverage.
You don't have any leverage. I mean,
Yeah.
you know? So I'm like, it's okay. Like for me at the beginning was like, and I'm like, I would still, it still had to be worth my time, right? And you're going to do business for 3 to 5 years. You better really like your partner.
Yeah, absolutely. I mean, like if you better like them and you better know how they do business, because yeah, otherwise it could be a rough partnership. But I think all of that's all really good, like insight and advice, because so many people listening to this, like I said, so many of our listeners are people trying to get started in this business. So you know, kind of putting that out there for people to understand, I think is definitely really helpful.
But I'll tell you number wise, because sometimes, you know, it's too generic and vague when you're like, well, this percentage from a listener who's new to the space, who may not have any clue. I'll tell you just from my own personal experience. My very first deal that I co-GP'd, I was on the loan. So net worth liquidity, right, was needed. And I raised capital, you know. Those were kind of the main roles. Everything else was like, yeah, they pretty much had it. But so I raised about 2.5 million on my very first project. And for that one, for a 5-year hold, my compensation will be about 700,000. And so for me, for a first time deal, getting that large, because it was a large project,
right?
You know, if it was a smaller project, you know, percentage wise, the numbers will vary. You know, most people aren't going to get that big a piece of a pie when they first get started. You know, so it kind of depends. But that was really, if I had to put a money number on it, my first deal, that would be my total compensation in the 5-year period would be 700, a little over 700,000.
And thank you for sharing that, because so, you know, as the listeners are probably dying to like get some of those numbers and understand, okay, what does that mean if I've got like a certain percentage of the GP, like what are the possibilities? So that was really nice that you shared that. And you know, nowadays, like now that you've grown and you guys have so many units, are you guys doing any like purchasing any properties just yourselves, to having your own personal portfolio on the side?
I mean, that's a long-term goal down the line where we might buy something just for ourselves. Right now, the things that we own ourselves are just the overseas things. But for us, scalability, because it's so much easier, like the amount of time it takes, because we're not the asset managers. Like we have one property that we co-asset manage, but everything else, like pretty much after the project is done, there's not a lot of heavy lifting left for us to do. The rest of the team kind of does the operations and the rest of it. So it's more on the front end acquisitions but once the project closes, there's not really a whole lot of work that Jaime and I do, because after that, you know, then we can continue on to our next project. Now, you know, if we wind up doing a project on our own, it would probably have to be a lot smaller, you know, for us to park a lot of our capital. I like the model we're doing, you know, now most of them are like 300 unit properties, and we divvy up the work, and it makes it really easy. Like the time commitment, like the whole reason I went into this was to buy back my time, remember? And so I wasn't looking for like, okay, a new career that was going to take up even more of my time. But this has allowed me true time freedom and financial freedom, because my work week, honestly, like my average work week now, combining my optometry and here, if I had to average it out for the month, my work week is probably about 8 hours a week. And so
that's the dream.
That's the dream. And so I've gotten to the point now I have enough cash flow for my practices, and that cash flow helps with my real estate, and my real estate has a bunch of cash flow. So it's like it cycles back. And so now it's just like, I just pick and choose which opportunity I want to join, and then divvy up the work. Because if I do it all by myself, that means that's a lot of workload. You know how hard it is from A to Z doing the whole shebang. And at this point in my career, I'm not ready for that.
One of the things that I wanted to, this is going back a little bit, but I wanted to kind of refresh the listeners that aren't aware. When you mentioned that you were signing on the loan, and providing the net worth and liquidity requirements, which are huge when it comes to general partnerships, because that's hard to get as a newbie. Can you remind our listeners what specifically that means? Like what kind of net worth and liquidity requirements lenders want to see?
Yeah, so the amount of the loan, I mean, you have to have enough, all the co-GPs, right? All the people are signing on the loan collectively as a team, your net worth has to be at least that amount. And you have to have the liquidity pre and post, like 10%, to have enough on hand. And for me, that's really important, the liquidity, because if something shall go south on a project, I want to make sure that I have co-GPs that have enough money on hand. So if we need to inject some capital to save the project through tough times, I want to make sure that we have enough money on hand, not just for lender requirements, but for real, right? If we're holding this project for 5 years, yes, we buffer and cushion in as much of the project as we can, but we want to make sure we do have that cash on hand so that if the project, worst case scenario, if something shall happen and we need to, put some cash into the project before having to do a capital call, because I don't want to do a capital call for my investors, that's worst case scenario. But lenders are very stringent on that, especially post-COVID with bridge lenders. I mean, aside from net worth and liquidity, like if you didn't have an asset class similar, and you don't really have a strong multifamily track record, it's hard, to
Absolutely.
get terms and to get good terms and get good lending. And
Yeah,
so,
I mean, even myself and Mike and Rich at Pike 3 Capital, I mean, early on with our first property, we needed to bring somebody on with the liquidity and net worth requirement. And we literally partnered with somebody just to bring them in for that one specific requirement. And they essentially didn't have any other roles that they were actively week in, week out doing. And for those listeners that are hearing this, that's not uncommon. Like it's very common to bring in somebody that has that can meet that net worth and liquidity and is willing to sign on the loan. Obviously, there's a price for that. Usually they're now a part of the general partnerships. But that's, just one of the many pieces and like you mentioned, that's actually a ton of value that you provided to the general partners by bringing that in and capital. So anybody getting into this business will quickly realize the value in that.
yeah, if you can bring that automatically, you can get your foot in the door.
Oh yeah, if you can bring that, you're gonna be doing deals because there's an unlimited number of people that are looking for that. And I think that barrier to entry is something that so many people don't know yet, or haven't hit that wall with a lender. And it's a huge one. I mean, like getting into large multifamily syndications, like if you're going to be taking down these double-digit $1 million properties, you've got to have somebody with the pocketbook to sign on that loan. And so that's something to keep in mind if you're trying to get into this industry. I want to go ahead and go to the last portion of our show, which is where we just ask our guests the same questions, starting with the first one, which is, what's the biggest mistake you've made in real estate investing so far?
Biggest mistake I've made was trying to do everything by myself when I first started. When I did start to try to pursue my first GP deal, I did a 56 unit deal in Pasadena, and it was self-managed. I was going to do a JV deal on that, and it was only because I was chasing deals that were in my 100 to 150 was my criteria. And I kept getting the best and final, and I kept losing and losing and losing. And I was like, you know what? I'm going to change markets. I'm going to go smaller. I'm going to just try something different. And I'm going to just JV it and do it by myself. And just shifting from my main focus on what I should have stayed with. Well, I did that, and it wound up being bad timing. And 2020 COVID hit, and then find out I put hard money, and then with all the lending and everything changing, I was like, man, I can't, it won't work anymore now. The interest went up every day. It was going up before we were closing. And then, so it was lessons, hard lessons learned. Well, anyways, I didn't give up on that deal. So I was like, you know what? I told the broker, I was like, I can't buy it at that price, and she won't discount it. So I know that because it's too early with COVID. So she's just not going to sell it. So tell her, just take it off the market. If she has another buyer, go ahead and have her sell it. But if not, then I want to see if the market settles down and I'll go back to it. So I worked on this 56 unit project for like literally, she came back to me because she never was able to sell it. I went back onto it. Well, anyways, I lost hard money on it. Okay. So my first project I tried to pursue on my own, I lost hard money.
And I'm sure that was a big chunk of change.
Yeah, well, at that time, at least it was a $4 million deal. And she gave me half of it back. We at least
that's nice.
That. So that was nice. And, but anyways, it was just one of those things, trying to do it. And I didn't leverage someone to do it the way I said I was going to do it. I should have just stuck with my game plan. And then I was like, okay, scratch that. I'm going to go back to what I said I was going to do, leverage an experienced team, get my foot in the door, learn that way. And then that's where it scaled. But trying to do it all on my own, or like, you know what, maybe I can do it all on my own. And, just do a couple of other partners. And I know people who've done that successfully, and that's fine. My personal mistake, that I lost money on that one.
Yeah. And all the people that I know that have scaled to these great heights in this business have not done it all alone. And it reminds me of that book, Who Not How. Great book for any listeners that haven't read that book yet. But determining like who can help you reach your goals instead of how you can just do it yourself. And I think that you hit that crossroads, and now here you are with over 5,300 units, as opposed to, you went from there to where you are now, and you did it very, very quickly. So extremely impressive.
It was just for an accolade of saying my first deal. I just wanted a first deal so bad.
You wanted to be able to say, and maybe, there's also a lot of weight that'll carry with investors and things like that. So I can totally understand why you would want to do that. Yeah. What, if you could go back and tell your 25-year-old self one piece of advice, what would it be?
Invest earlier.
Right. I feel like everyone should just say that.
Invest in real estate earlier.
Yeah. But syndicate multifamily earlier. Because imagine where you'd be now if you would have started at 25, right? It would be insane.
25, if I would have done multifamily syndications, that would have been insane.
Yeah.
And also my level of confidence. I just was so complacent and comfortable with just knowing, and being doctors. Doctors are some of the hardest, just kind of comfort zone. It's like everything else is like too scary, it's too risky. It's so funny that you would think that with all the volatility of the stock market,
right?
Doctors, because it's familiar. And so familiarity leads to a certain level of comfort. And so that's where I was, anything else was like, oh, it's a scam, or I wasn't open to it. So I think I would have told my 25-year-old self to be more open-minded and to continue learning, to continue self and financial education, because they don't teach you that in school.
They don't.
They don't. And so I wish my 25-year-old self would have done that earlier, read the books, gotten to different communities, learn more what was out there,
I love that. And you're totally right. Like they don't teach all that stuff in school, and you just go with what everyone else is doing. Everyone from the moment you're in high school all the way to an adult is talking about maxing out their 401ks and then investing some extra in their own stocks and stuff like that. And they're not only fearful of, maybe doing like the multifamily stuff because it's something they don't know, but also because like they're so used to hearing about stock market single digit returns and some people getting lucky and killing it, that when you tell them 20% average annual return over 5 years, some people are like, whoa, I don't know about that.
Too good to be true.
Yeah, too good to be true. And you're like, it's happening every day right now. So totally get that. Next question. There's only 2 questions left. How would you recommend others to obtain the knowledge needed to get started and take off in their real estate investing?
Educate, educate, educate. not just educate, but you got to get like, you have to take action. Like a lot of people go to a bunch of seminars and just read a bunch of books and listen to a bunch of podcasts, and they just don't do anything with it. And so you do have to have trustworthy people that are doing it successfully, that I think if you can at least just have a few of those in your circle, that would be good. If you can get a coach, or I'm big into investing in self-education and in yourself and learning the ropes in the right ecosystem or in the right people, and so you have to, I think live for me is more valuable. Obviously, starting with, anywhere you can, virtual is great. A virtual community to me is live enough. Like that's more valuable than just reading a book.
Absolutely.
So what we're doing right now and listening into things like this is very valuable, right? Because you hear real life people, like average Joes who are just you and me, and like we're real people getting and doing these things, right? And so I think just being open to learning and growing, and just read and learn and go to events, meet people. Don't be afraid to ask questions and learn. And go directly to the source. If you know somebody who's doing something, just go and ask them. They're all people. They all started somewhere. Trust me, the most well-known people who are doing or killing it in the field started off with something. They started off not knowing anything in the industry.
Exactly. And the biggest teacher you're going to have is going out and taking action and doing things yourself. I mean, I am one of those people that was obsessed with every podcast I could get my hands on, reading every book that was mentioned on a podcast or that I could Google, conferences, meetups, all of that. And I still learned more, probably more with my first deal, which was a 32 unit with my partners, than I could have ever learned reading more books. At the end of the day, you're going to make mistakes. You got to just start taking action. And I think obviously the education portion is huge. And a lot of that education stuff does cost money. But you're investing in yourself if you're going to actually take the action. I spent, I'll tell everybody, I spent $78,000 on, or about $70,000 on education, mentorship, things like that. And I have made that many, many, many times over in my returns by doing that, and then partnering with those people and things like that. So I think you got to look at it as an investment.
But you nailed it, Sean. Honestly, the best education is just doing your first deal.
Yeah, you just got to do it and not be afraid to make mistakes, because I promise you will. I don't think it's really possible for you to go out there and do your first deal and not make a single mistake. You will. And just accept it.
And that's the growth path. The people who are, like you said, if we weren't going out there and just doing it, we make mistakes, but we learn and we build that confidence, and you just get out there and you get back up and you get out there and you keep at it. But like you said, you can read, but do get the foundations and understand and learn. And like you said, 70,000 investing in your education, you well exceeded that in your returns.
Oh, absolutely. Absolutely. And I was going to have one more question, but I'm going to add one now, because I want to ask you, what's one thing that after doing like your first one or two deals that you will never do again? You learned your lesson, you'll never do it again. I've got a bunch of them, but
that I would never do again.
I'll tell you one thing I would never do again. I don't think I ever want to buy a distressed property or a heavy value add 1968 vintage ever again. We made out really well, but the headaches and how difficult it is, I'll never do it again.
I keep hearing that one. So I've never actually done an older project like that, heavy value add. That's not our criteria. So I haven't done one of those, because I hear all the stories about them. I'm like, not doing that.
Yeah, you're like, hard no.
Hard no. No, I don't know if there's anything I would say I would never do again, because we've been very lucky that our partnerships have been very good, and every partner that we've partnered with, we've learned a ton, and they've been good. They've been good friends and things like that. So I think that helped us kind of guide us from making a lot of other mistakes.
Yeah, for sure. Well, that's awesome. You're very fortunate. You've had incredible success. just explosive growth over the past 5 years. So final question, how can our listeners get in touch with you?
Probably the best is to get on our website, Passive Wealth, the number 23.com.
Okay. PassiveWealth23.com. Thank you so much for coming on our show. You're an awesome guest. I think you provided a ton of value. And in particular, I think a lot of people listening, you probably inspired them to go take some action on partnering and education and things like that. I think you had a great story around all of that. So on behalf of myself, my partners, Mike and Rich, and our whole team, thank you so much for coming on the show. Thank all you listeners for listening, and we'll catch you on the next episode.
Thank you.
Thank you for listening to the Multifamily Takeoff podcast. For more information regarding anything multifamily real estate investing related, or if you would like to subscribe to our weekly newsletter, visit the multifamilytakeoff.com and be sure to follow the show on Instagram at the Multifamily Takeoff. See you next week.